Well, let's get officially started. Good afternoon and welcome to Inside the Nonprofit Audit, What to Expect and How to Prepare. For those of you with a 12/31 year end, it is that time of year. It comes around so quick. But for those with 6/30, 9/30 year ends, we have a couple 11/30, we have an 8/31, right, Sally?
We
So there's
do.
many different year ends. This will help you get ready, and the timing of it would be great. And so you'll be well prepared for your audits. Just to share, I'm Julia Lafferty, partner and director of the nonprofit services at CBM. I have been working in the nonprofit arena most of my career as an auditor, really strictly auditor, some tax work related to 990s. And I hope we can share with you some ways to make your audit a positive learning experience. As I often say to clients, we're the auditors and we're here to help. That's not what they think. They sometimes laugh, but to me, it's not a joke. We want to work together. We want to be part of your team. So I'm going to let Dominic introduce himself.
Yeah, thanks, Julia. So Dominic Balia here, a partner at CBM. I lead our accounting and advisory services group. So working very closely with nonprofit organizations through our fractional CFO, controller level, and outsourced back office functions. And so I'm here to offer the perspective from the client side of the audit, where we support audit readiness throughout the year. And so hopefully I'll be able to share some tips with you on how to prepare in advance for the audit, and then how that audit will, go, whether you have an outsourced accountant or not, just sort of what you can do on the client side to prepare.
That's
Sally?
awesome. That's awesome, Dominic. And Dominic has great relationships with his clients, and that comes from communication. We'll be talking a lot today about communication. And Sally works with me. Sally, could you introduce yourself?
Sure. Thanks, Julia. I'm Sally Hudson. I'm a senior manager here at CBM, and I'm in the nonprofit audit side of things. I have about 15 years experience in public accounting, and most of that is with nonprofit audit.
So Sally and I work together quite a bit. So this audit stuff is what we do every day. And I know you don't do it every day. And you probably say, thank God I don't have to do this every day. But we do it every day. And we're just really excited to share some of the things we see and some things that would make your audit a little bit better. I just want to share a wee bit about CBM, and if Dominic or Sally want to add to this, please do. CBM, or Counselor as we call it, is a full-service tax, accounting, and consulting firm located in the DC metro area. We've been serving clients for over 100 years, which I think is pretty cool, and I have not been here that entire time, for those of you wanting to know. And we have about 100 service providers across a number of industries. But the three of us, along with about 70 individuals, focus on nonprofit audit, tax, CAS, and other consulting areas. We also volunteer our time in the nonprofit arena by taking on leadership roles in organizations like the Greater Washington Society of CPAs, the ASAE, and we all serve on nonprofit client boards. So we do have communication when we're talking with your board members. We know where they sit, and we think that we're able to provide really good information in that way. We also teach a nonprofit certification course called CNAP. If you're interested in that, you can look that up on our website. And we present webinars such as this. So we do take our role in the nonprofit arena very seriously, and we try to give back in this teaching mode too. So as we go along, please feel free. Oh, someone's praying for snow, I'm just noticing. That's nice. Please post any questions you have in the chat. We'll try to answer them as we go along, or if it's more complex or something, we'll wait to the end. And of course, if we'd run out of time in any way, you're happy to get in touch with us, or we'll get in touch with you to talk about whatever you want to talk about. So we're moving on here to the learning objectives. Audit expectations. It's really not a secret what we do, and we don't want it to be a secret. We want you to expect that we're doing a risk-based audit. So that's the big hint, that we're looking at the more difficult areas, the areas that you consider high risk. risk in most cases. And we'll talk a lot about that. Your team is just getting everyone across your organization prepared. You have to get the HR group, the fundraising, membership. You have to get all the departments involved in the audit and let them know it's coming. It's not fair to them in some ways just to ask a question randomly one day. It's better if they know that this is going on and these are the questions that they're going to be asked. Interactive discussions, that's really important, especially in the case of having an outsourced accountant, a CAS team, and perhaps also some work that's done in-house, and then your external auditors. Sally and I work really hard to have those three groups coordinate, that we work together as a team to get the audit done, because it won't get done without all three working together. So that we really feel that's key to a smoother audit. Let's go to the next page. This is the course outline. Dominic's going to be talking about audit readiness and how important it is to be prepared when your auditors start. The dreaded PBC list, or the prepared by client list, Sally's going to share some information on that. It's really, really a helpful tool, and it's not so bad once you really sit back and think about it. And we do perform a risk-based audit, and I'm going to talk a little bit about that. That also helps to avoid surprises if you sort of know what we're going to look at. And as all of you know in the nonprofit arena, revenue recognition is probably one of the most difficult areas that we have to deal with. So Sally's going to spend a little bit of time on that, and then we'll have a few other points and notes as we go along. Let's see. Oh, and this is what a successful audit delivers. You always think of that clean, unmodified opinion, and that is key in the audit. But there's also other things that are also very important. You know, we generally meet with the board or the audit committee, or sometimes both, and report back to them our findings. We talk to them before the audit starts, and then once again at the end of the audit. And it's important that they get a positive report. And that doesn't mean everything was perfect. Sometimes that means this is what we found, this is what we talked to management about, and this is what their plan is. That's a positive report. You know, not every time everything's going to be perfect, but that fact that management's aware, they see what the issue is, and we're going to move forward together. And just as a side note, when we come up with anything in the audit, we immediately talk to management and discuss it and make sure we have all the facts right. Sometimes we don't know all the facts. There might be another way that it was approved that we didn't see. So we always go through that first. And please always ask your auditors to do that, because there's not much sense in moving forward if you don't have the right facts. And the facts are the facts. So that's all that we share. And then an internal control letter, whether it be material weaknesses or significant deficiencies, could come out. And if we find those, that is a required letter. Otherwise, if we just have comments to help the efficiency or the effectiveness of your system of internal controls, that will go in a separate letter. And those are just helpful hints, best practices, that sort of thing. And those are what we call suggestions for improvement. I'm going to pass to Dominic to lead our discussion on audit readiness.
So yeah, before I start, I do want to go back to the last point in the slide about the recommendations letter. Can we go back one slide? I just wanted to bring that up, because one thing that's become a topic of discussion recently for a few audits that I've been involved with is when the auditors will sometimes combine a letter with any material weaknesses or deficiencies, and also combine the recommendations. So many times the letter, the board may want that letter, or the management may want that letter to be split, so the recommendations are separate and go directly to management only instead of the board, because sometimes the board may misinterpret that as deficiency or weakness instead of just an outright recommendation for just improvement. So I wanted to ask also Julia and Sally, are you always separating that letter, or do you only do it when a client is requesting it, or how do you normally approach that?
You know, it really depends what the areas are. And if we have material weaknesses, and that's not something that happens on every audit, we would definitely have a separate audit or letter for both of those material weaknesses and significant deficiencies. We also really encourage management to have their response. And we try to make sure that those are in step. We discovered, during the audit, we discovered such and such, and management comes back and says, yes, basically, we agree, and these are the steps we're going to take. And that's a very positive letter and helpful to everybody. But to have other items, and I'm not sure exactly what you're talking about, but perhaps saying that there's these new pronouncements coming out and those types of things, I would put those in a separate letter in that type of situation. So there's not confusion. Sally, do you do anything different than that?
I agree, Julia. And with that management response, a lot of times they have either already taken that action, but again, it just depending on the timing of the audit, that same recommendation may appear again the following year too.
That's a really good point, Sally. Sometimes it takes more than 1 year to get out of a material weakness situation, because by the time it's discovered, you could be at least halfway through the next year
Right.
with those same processes in place. Really good point. Thank you.
Right. Sure. Okay. So moving on, I just want to start with audit readiness and really setting the expectation on how we think about being ready for the audit or when we start preparing for the audit. So for most organizations, preparing for the audit will not really begin, when audit fieldwork begins or a few weeks before audit fieldwork begins, but it's really just habits that take place throughout the year as the year goes on. So it's putting in different processes and procedures, making sure people follow them, and also just being organized throughout the year. So one simple but really effective habit is maintaining an audit folder. So that could be in your Windows Explorer, it could be in your SharePoint or some other tool. But really the goal is the same, right? You want to have key documents or important issues documented and save those in an organized fashion throughout the year so that you're not scrambling looking for them later or trying to remember where you might have important concepts to look up. So that's one simple but effective tool. But also just involving and knowing what is involved in the audit is not just a finance function. So even though the executive director or the CEO is going to be ultimately responsible for everything, and the people in the finance area will be supplying the auditors with most of the documentation or all the documentation, it really involves a full team. So for example, on the development or the membership side of the organization, they're usually dealing with important documents that might include donor agreements, grant award letters, sponsorships, bequests, event documentation for large conferences. So all that documentation is going to be important for the audit. And so the development side, if they're filled in ahead of time on what's expected of them for the audit, then they could be better about how they're organizing documents or what they're obtaining from donors or members or just the customer side. Not all of that is always going to live in the accounting system or the accounting work papers. And then from the HR perspective, many times the auditors will request things like employment agreements or contracts, benefit plan documents, census information for retirement plans, explanations of bonuses or changes in pay, severance pay, all of those things. So the HR leaders are going to be tasked with organizing those documents and supplying them for the audit. And so if they know, again, ahead of time what's expected of them, then they may be organizing those in a different way, or at least having those documents ready for the audit. And so those organizations that are looping in the team and providing more of a team effort, those audits are going to go much more smoothly, obviously. And this way, when you know who owns those documents and those processes, and they're all working together collaboratively, that audit should go smoother. An ongoing, what?
You don't mind if I add something?
Sure.
And I see in our audits that groups where they have, and I want to mention this, when they have like monthly meetings with all the program directors, including the accounting group, the CFO, they seem much more aware of what each other is doing. And also sometimes they're looking at the budget to actual in those monthly meetings. And it really does create more responsibility on those other directors for the financial piece of things. So just a thought, Dominic.
Yeah. And actually, to build on that too, before I get to the last bullet point here, I'll just give an example of something that we find very often. So an example is when there's an AMS, so an association management system, or a CRM for the customer resource management. And so let's say your membership or member clicks or Novi or some other AMS tool. What we usually recommend is that all the information related to a transaction should live into that system so that you can pull a report at any point in time for a period of time and have the information by revenue account, for example, or the total by a certain period. So one thing that we often see is we'll have someone on the client side at the organization. The information in the AMS is very generic, and then they'll export the information to Excel before giving it to the outside accountants or the people on their finance team if it's in-house. And then they start adding all the information line by line to the transactions in Excel. So for example, it might say membership revenue, it might say sponsorship or conference registration. And we think that's a really limited way of providing that information because you're making a decision on every single line item. So now the human error is high. The risk of human error is very high, but also it's very manual. And in the event the auditors want to pull a report from a specific period or for the full year, it's not going to be easy because you're piecing together all these different Excel worksheets. So what we always recommend is what we think is best practice is the system should be set up so that all the transactions are sort of automatically coded to those revenue accounts with a GL code there, and then you can really pull the information and tie it to the general ledger. Because nowadays, with all the data and all the tools available, auditors are now using that information in a way that they can say, okay, well, if your AMS says you had $1 million in membership revenue, but now your general ledger says 780,000, what's the difference? Good luck trying to figure out how to reconcile that because it's very difficult. So that's something that when you have the development side and the people who are involved in the revenue side, the money coming in, if they know that that's the way the auditor will operate or that they will ask those questions, then they will make sure that the information is in there correctly from the start, as opposed to trying to piece it together later or trying to fix it later. So I think that's one really big example that we see fairly prominently. And we
I
try to
couldn't
fix
agree
that.
more. And I see Sally shaking her head too.
Yeah.
That
Yeah.
reconciliation process can be really painful. And we also encourage that then once they do, as you just explained in the coding, then they reconcile every month and it's really easy.
Right.
So yeah, we couldn't agree more with that.
And usually the best people to be looking at that are the ones on the development side. So if you have a development director, someone dealing directly with the members or customers, donors, those are the people who are best involved in that process, to be involved in that process. So that's just one example. And then moving on to finish the notes here. So ongoing communication with auditors. So that means that if the auditors are scheduling meetings to prepare for the audit or a kickoff meeting or weekly meetings throughout the audit, that's great, but also outside of the audit timeframe, ongoing communication. So as an example, if there's a significant event or something new or unusual that comes up, you may want to just run it by the auditors and say, hey, just a heads up, this way they can put it in the file, or even if you're unsure of how to handle that, maybe the auditor can give you some advice on the front end. So we find that to be really important for a smooth audit.
And from an auditor standpoint on that, we really like that. We like when they call and we have a conversation about it. We don't want surprises at the end of when it comes time for the audit, where they
Sure.
said, we've recorded this as a contribution and we're coming in and looking at the kind of say, it's looking more like a fee for service. But if we could have had that conversation in July when that came in, we would have been consistent. So we really encourage that.
Yeah.
Right. So moving on, so here we really get into, I guess, the heart of what audit readiness is from the nonprofit client perspective. So most audit delays when the audit is going on, they don't usually occur from one area, but usually from a mix of multiple areas. Maybe mistakes that are made throughout the year or gaps in documentation that are throughout the year rather than just one incident. So one of the most fundamental steps throughout the year, of course, is a timely monthly and year-end close. So that means bank reconciliations. This may sound obvious to many, but it's not always this way in practice. But a bank reconciliation or the basic reconciliation should be done every month, not 2 at a time, 3 at a time, or waiting a few months to get it done, because sometimes questions may compile and they're much more difficult to answer and address when it's been a few months since the transaction date, as opposed to keeping up timely. And also reconciling all the balance sheet accounts. So we have a philosophy that you should have a supporting schedule for every balance sheet account. So for example, cash, of course, will be bank reconciliations. Investment accounts, you might have in a schedule that sort of summarizes the activity. Obviously, prepaid schedules, deferred revenue, and all of that, net asset releases. And so you should be reconciling those accounts between the general ledger and then your support every month, and actually having a supporting schedule to reconcile to. So we've dealt with some clients and their accountants, and oftentimes just general bookkeepers, who have said, well, all the information's in the ledger. So if you want to pull together the prepaid expenses, just look at the detail in QuickBooks. That's not really best practice. You should be having a schedule that outlines, okay, if this is a prepaid expense and it's recognized over 12 months or 6 months, you should be showing that progression throughout the year and then accumulating all those different prepaids. So that's another fundamental concept of audit readiness, and just, good practice. And then equally as important, we think, is documenting all the reviews and approvals. So it's one thing to have those schedules, but then somebody else should be reviewing them, particularly the CEO, executive director, should be looking at the bank reconciliations monthly or quarterly, and also the adjusting journal entries. So if there's journal entries that are posted by an internal finance team or an outsourced accountant, somebody should be reviewing those on a regular basis. Oftentimes we see that quarterly just because they can accumulate and it's easier to look at it from a batch efficiency perspective, but monthly is also really good practice. Annually is okay, but just obviously not as effective as quarterly or monthly. This way you can stay ahead of things. Also, unusual transactions, documenting the accounting treatment and just the nature of those transactions is important, and somebody else should be reviewing that. And then you have that information available for the audit when requested. Also just accounting treatment for various complex accounting items. So we'll talk about revenue recognition in a little bit, but one example would be when you have a sponsorship agreement or some sort of revenue item that has multiple components. You want to document those different components, how revenue is recognized, and what value is being used for that revenue. And also defining the ownership across the team. So I touched on that a few minutes ago on the last slide, but just making sure you know who owns those various areas. And that could also be, if you have an outsourced team, who's going to be in control of what areas of the request list or the requested items versus the client side or the executive director. And then the executive director usually should be the person who's looking at those items overall and assigning who owns them. And designating a primary contact, again, is really the function of the person in charge, the director, the CEO, just looking to say, okay, here's the different areas, revenue versus payroll or employee benefits, and just assigning those various contacts. But we think it's best practice to have one person or maybe no more than two people who are interfacing with the auditors, so that you don't have, sometimes you get paralysis by too many people being involved because everyone thinks the other person is answering, or you get delays that way. But it's also just much more efficient for someone to take the lead and run point on all the various items and requests. Next slide there. So talking about the evidence of review and approval, here's just a little bit more detail on how you can make sure you're documenting that. So the journal entries, particularly the adjusting journal entries, are the ones that you want to have approved. And so you can approve them in any number of ways. One way would just be to send a report, have a report of all those adjusting journal entries. The director, CEO peruses them, sort of reviews them quickly, browses any questions on them, asks questions before approving. But then once all are approved, just sign off on the PDF. That can get scanned and saved with the other documentation. Another way to do that is through email. So somebody can say, hey, can you review these journal entries for our documentation? And somebody writing back and saying, yes, I've reviewed and approved them. That would be satisfactory, but you also want to make sure all the information in the email is enough to be able to confirm that what they're reviewing, and then save that in the audit file. So that goes the same with bank and credit card reconciliations. Credit card purchases, another big one. So having someone sign off either on the actual statement of the credit card reconciliation or the credit card activity, or the reconciliations, or using tools like Divvy, bill spend and expense. Ramp is another one. They have built-in approval processes there that you can do on the front end or the back end after the transactions go through. And again, with the significant estimates and judgments that I was saying before, even with various components of revenue items, and those should be documented and saved in the audit folder. But one thing that we do, one thing we see often too is at the end of a monthly close, for example, putting together a packet. So the packet may include all the bank recs, the credit card recs, adjusting journal entries, and then someone can sign off all at once. So it's not all this different piecemeal or fragmented approvals. Go ahead, Julia.
Yeah, well, one, I love that packet. Because as
Yeah.
you all know, we cannot do the CAS work and the audit work. So we don't really get packets from Dominic, but it sounds like something we would really like, won't we, Sally?
We would.
We would, we would. And then I just want to just emphasize the credit card. I have many clients where that becomes a really big issue if they're not properly approved, and that only the people that need them get credit cards. It
Right.
can become a real mess real quick. And if there's a lack of discipline where they let people go a couple months without reporting back, this can really become a mess. So I really encourage that this be done on a monthly basis. But I just thought I'd add from the audit standpoint,
Yeah.
we've seen it become quite a little mess.
Yeah.
Yeah, and the credit card, we always say credit cards are easier on the front end because you can make a purchase quickly, but then because of that, the accounting sometimes after that can become lax, especially if you have someone using the card who has many responsibilities like a director, and they don't dedicate the time for the accounting side of it. That can become messy. And also if you're sharing credit cards among staff, that can become difficult. So that's not a best practice. That's why we like tools like bill, spend, and expense, because you can easily create virtual cards and add receipts and add coding directly there. But we always say, with a credit card, it's like with great power comes great responsibility, right? So if you have that credit card, you have the responsibility. No one knows better than you what you purchased. And so that actually is a big focus in the accounting side, is the credit cards.
Agreed.
Yeah, and just to add, one of the key controls that we look at as auditors are these approvals. And if it's not documented, then we consider it not done. So just again, just emphasizing the importance of documenting, and of course, these systems like Divvy, where the approvals are built into the system, really makes it easy for everyone.
Yeah,
and also like Bill, it's really, I don't think we talk about this in this presentation, but from the audit standpoint, we can get view access. And it really helps the audit without us asking for as many, pull all these invoices, because we can just hop in and take a look at it.
Good point. Okay. And then talking about the client contact, the primary contact, and who's running point. So again, I mean, our opinion and our experience is that audits do run smoother when you have those roles clearly defined. And so the typical audit communication or coordination is that at the beginning of the audit, or a few weeks before, maybe even a couple months, depending on the auditors, they'll issue what's called a PBC list, which we'll talk about in a few minutes. And the primary contact would then run through that PBC list, figure out what their team can provide, or who on their team can provide what, and assign it out. And if you have an outsourced, accounting team, then you could figure out what should go to the outsourced team and what should stay in-house. So you coordinate that, and then you can have everyone working concurrently. And then from the outsourced side, typically when we're the ones working with the auditors and the nonprofit director, we will usually take the first pass. So we'll intercept that PBC list. We'll filter out only what the nonprofit internal team needs to focus on, and we'll do the rest. That usually will limit the disruption to the nonprofit team, so they can keep on going with their important day-to-day tasks. And it also improves, in our opinion, the quality of the responses, because we can understand and filter out exactly what the auditors need. And sometimes, Sally and Julie may not like this, but when we look at it, we only want to provide what is needed as opposed to providing more, because we just don't want the audit to get deeper than it needs to get. So sometimes having us involved will also just sort of make the documentation more concise and focused.
We like clear, concise answers.
Yeah, I was gonna say, I would appreciate that, Dominic, just because sometimes too much information can just lead to delays if we're sifting through a lot of documentation that's unnecessary.
Yeah.
Well, sometimes I think you'd agree, Sally, we get all that information because the client potentially doesn't really know the answer. So they just feel like, we'll just give you everything we got and you figure it out.
Yeah.
Good. And the next slide. So this is just in summary, right? So everything we talked about. So planning ahead, working with the audit firm on timing. When do you need the PBC list, the request completed? When do you need the adjusted trial balance to begin? Assigning those requests to the appropriate individuals, and then just understanding how those audit requests will be managed. So again, if there's a PBC list tool that we'll talk about in a second, so there may be a tool that organizes everything so people can collaborate together. Just understanding how that works and any notifications will be useful, and providing those files as they're completed. Right, by doing it this way, I think in summary, this is the last point I'll make, is that by having an idea of what the auditors will need throughout the year and organizing it as best you can throughout the year, then the audit process becomes more like a double check as opposed to a mad dash or scramble to get all the information together before the audit. And so that actually makes it a lot less burdensome for anyone involved with the audit. And so this is, yeah.
Yeah, I agree, Dominic. And sometimes I say that monthly discipline, the year-end close is not that much more than what you do on a monthly basis. I
Right.
know a few organizations have a few things they do a little different year-end, but it shouldn't be like starting from scratch. It should be
Right.
really doing your normal year-end close with maybe a few additional items.
Right.
The other thing I want to
Your
talk
normal
about.
month end close with a few.
I'm sorry, did I say that wrong? Normal month end close with a few additional items. Right. I also want to talk about timing. We usually start with our clients when we're talking about timing is we back it up to when is your board meeting? And they'll say that's April 15th. So we want to send out to the board at least a week before. So we need to get it to you 2 weeks prior to that. And then you kind of come up with, let's say it's March 15th and we did all that work. And then we have to back up to when we can start the audit to make sure that we're ready for that time frame. And for us, we generally think of completing an audit from the date fieldwork starts until you get your draft as 5 to 6 weeks. We try to keep it very condensed and get the work done timely. But you also have to think about other things that are going on in your organization. We just had a client that scheduled their audit right during their biggest conference of the year. And this conference, almost everybody goes to it, except perhaps the accounting manager. But the CFO was out, all the directors, the fundraising director, the membership director. So that first week when we were trying to do the audit, there was no one there to answer those questions. So you do have to also think what's going on within the organization. You don't want to schedule it during big conferences. Don't schedule it when you know you're going on vacation. We get that one sometimes too. Start the audit, but I'm going to be out for 4 days. Like, okay. So just think about all that because you want to get it done. You want to be efficient in this. I think everyone benefits from that efficiency, just paying attention and focus on it in that short time frame and get it behind you so you can move on to what's going on in the organization this year instead of looking backwards. That's just my thought on timing because I think it's really important.
Thanks, Julia.
You're welcome. I guess we're moving on to Sally.
We
and
are.
the
I want to
PBC
talk
list.
about the PBC list. What is the PBC list? So that's either provided by client or prepared by client. So this is a listing of documentation that we request during the audit. Sometimes auditors may email this to you in the text or Excel, or they may use these PBC tools, as Dominic had mentioned before, such as Smartsheet, SureLink, and Flow. We use Smartsheet, and for example, it's a web-based platform, and it kind of looks like an Excel spreadsheet. And we can have every request on there, and then you can upload directly to that request line item. So it really allows for that collaboration, as Dominic said, among the team. So we can give access to, obviously, the finance department. If the CEO wants to have access to keep an eye on things, they can have access. If you want payroll to be able to have access, that could be given to. So it really allows for the full team to be involved and assign those requests to the appropriate parties. It allows us to interact with the client back and forth through comments. So it's really eliminating that email back and forth that could get lost, and really keeping the whole team on track. And typically PBC lists are organized into various categories. I'll start with the general documentation. So this is stuff like your trial balance, your general ledger detail, your internal financial statements, your balance sheet, your profit and loss statements. Budgets, any budget amendments are very important to provide as well. The listing of bank accounts. So that listing should include things like the bank name, the account number, and who the signer is. And it's really important that you review the signers each year, adjust it if it's deemed necessary, if there's any, obviously, turnover or any new people that should be added to the account. And we use that to send out the account confirmations during the audit. So that's when we confirm the bank balances directly with the bank itself. So we really love to have that information early on so we can get those confirmations out and have it ready by the time we start field work. The variance analysis between prior year and current year, I think this is probably one of the most important documents as you prepare for the audit. So when you're reviewing the accounts from last year to this year, that's really when you're identifying any areas that may need to be adjusted. If something might stand out, like, oh, this account didn't change or it changed significantly, what happened? Something got reported in the wrong account. So it's really important that you're doing that analysis as you're planning for the audit. And it really helps us plan for the audit as well. So we're using that analysis to see the significant accounts, see what really changed during the year. Grants increased a lot. We can ask the question of what new grants did you get this year and start gathering that documentation early on. And it goes into our risk assessment as well. Same goes for the budget to actual variance analysis. As Dominic said, it's great practice to go over these account fluctuations and budget actuals during the year so you can start seeing any differences that might need to be reconciled or recorded incorrectly. Board minutes, we always ask for the year board minutes. Again, that just gives us some more detail to go into our audit planning and the risk assessment process, and as well as internal control documentation. So that's your internal control memos on your cash disbursement, your cash receipts, your payroll processes. And again, that goes into our risk assessment so we can easily identify your key controls that are in place over these significant processes.
Sally, can you just mention very quickly how we set priorities on these items and ask for certain things early on?
Yes, yeah. We do try to add some due dates to our PBC list. The priority items are always going to be the trial balance, that current year to prior year variance analysis, and these internal control memos. We typically like to ask for that at least 1 week prior to field work starting. And again, that just gives us the preparation and the time to do our risk assessment and really make sure that when field work start on day one, that we're ready to roll. Account reconciliations, as Dominic mentioned, it's really important, and we also agree that it's best practice to have a reconciliation for all balance sheet accounts. Of course, not every organization is going to have all these documents here that are listed. Depends on your operation, but a couple things. Bank statements. The auditor is definitely going to ask for your last bank statement of the year and the subsequent bank statement. We a lot of times ask for the bank statements all for the whole year because sometimes it's just easier to ask for that up front. So as we're doing our testing, especially with revenue, we can easily tie the transactions back to the bank statement without having to ask you for another bank statement during the audit. Your calculation for the allowance for doubtful accounts and credit losses. Again, just making sure that calculation is done before the audit starts and someone's reviewing that. Your net assets. So having a net asset schedule broken out by the donor restrictions and without donor restrictions. So this should detail out your beginning net assets, your additions and the releases, and then of course your ending net asset balances by program and any timing restrictions as well. Going over to revenue, so all your revenue reconciliations, any membership due tracking spreadsheets you have, any of these internal spreadsheets that may be helpful to the auditor to tie things out to the trial balances and to have more detail to test from is helpful. Reports from other databases. So if you have a membership database, we may ask you to pull out, like Dominic had mentioned, those reports, and we're going to look to make sure that those reports coming out of these other databases do tie to the trial balance. So make sure that reconciliation is done and complete before the audit starts. If you receive any grants, so any monitoring of those grants, and any in-kind contributions as well. Looking at expenses, we always ask for a salary reconciliation. Again, this may be where you pull in someone from the payroll department to have them help out. And we're looking for the payroll reports as well. And then the auditors will typically select samples to test specific expense accounts. Those accounts may change from year to year, and it really just varies on the risk and the volume of transactions and the significance to the organization. And lastly is the statement of functional expenses. This is a statement that we typically receive near the middle to end of field work. Of course, because if there's any adjusting journal entries, they may impact the statement of functional expenses, and that would have to be updated. But again, that statement we need before we can start preparing the financial statement. So it's very important that that comes in timely. Then we have the permanent file documentation. So these are all the core documents of your organization. So your articles of incorporation and bylaws, your IRS and state exemption letters, all of your accounting policies, your employee handbook, any investment policies that you have in place, conflict of interest, and so on. And these are usually something that we ask for in our first year of audit. And you may not need to upload those to the portal or provide this to your auditor every year, but you would provide any updates or amendments to these documents each year. Lease amendments is something we see very frequently. Again, this is really important that you have a separate auditor folder throughout the year. So say you amend your lease, you can easily drag that amendment into your auditor folder and provide that when we send out the request list. Any significant contracts or agreements that were signed during the year, any line of credit documentation, and your retirement plan documentation, any amendments there. All right, Julie, do you want to talk a little bit about risk-based auditing and what that means?
Sure. It's really not a secret that auditors focus on the high risk areas. And so when you're doing your audit prep, think about those areas. And the high risk areas tend to be revenue recognition. As a matter of fact, this is an item that's listed in every engagement letter that we do for a nonprofit, is revenue recognition is a high risk area. Your in-kind contributions, get your documentation in order, because we're going to look at that. If it's small, it's not as big a deal, but Sally and I have some clients where this is very large, and Sally's going to talk about that a little bit later on. Sponsorships and special events, provide us with that documentation, your calculation of the contribution versus exchange components, and how you calculated that. Donor restricted and conditional contributions, got to read those contracts to determine what's in there. So those tend to be very high risk. It's also an area where sometimes we have adjustments when we're doing the audit, when we look at those. So also just think of your more material accounts, or where there's been significant changes. I think Dominic was mentioning, or an unusual transaction. That's where your auditors are going to focus. And really, what makes an area high risk? It's really when it requires a lot of judgment, it's complex, or the documentation isn't there. So requiring significant judgment could be something like an accounts receivable allowance, and you are using judgment to determine that. Involving complex or not routine transactions could be something like you sell a building, and what are you going to do? So think about anything big that happens like that, and that would be a complex transaction. Leases sometimes can be very complex, so you have to really think about those transactions. Has multiple potential accounting treatments. And again, that's something like membership dues, where part of it can be dues and part of it's a contribution. And Sally's going to touch on that a little bit too. Or where it lacks consistent documentation or policies. There are times when your fundraising group comes in and says, hey, I got $1 million. And you're like, hey, that's awesome. What documentation do you have? I don't have anything. So then you have to back up a little bit. Sometimes we even find these when we're doing the audit that they've never really gotten any documentation. And then we have them go back and look at emails. And sometimes we can piece it together through emails. We don't want to make a donor change their mind because we're asking too many questions, but we really do have to understand the intent of that donation. So that's just a example there of that. So preparing for high risk areas, document. I'll just say that. So when you have a key area like the accounts receivable allowance, document what you're thinking, your thought process, and how you're getting there, what you're assuming. You're assuming everything over 180 days we won't collect. And why is that? Because we tested it last year and looked at where everything came in and we didn't collect anything over 180,000. It's just documenting those judgments and assumptions. Retaining the agreements and support for valuations. That's if you get gifts in kind and they're sending you valuations, save that information. Apply your policies consistently. Be consistent year after year. You can have changes in policies, but your policy shouldn't change every year. It should be really well thought out if you want to make a change in a policy. But and those are things we would report to your audit committee as required by our SASs, is any change in policies if it's significant. Ensure evidence of review and approval. As Sally said, if it's not documented, auditors believe it did not happen. We believe you, but we need the documentation to support that. And then identify the nature of transactions as they occur. So when you get a transaction, go ahead and do the accounting for it. You get a contribution in. Don't say, oh, I'll do the accounting later. You need to do the accounting now. And this is where we would love if you give us a call. If you're unsure, call your auditors. We have this transaction. This is what we're thinking. Do you have other thoughts on that? And we're happy to share and walk through that. Or call your outsourced accountants, the same thing. Make sure that you're comfortable with where you are in recording those transactions. Let's see, are we moving on to Sally or?
We are. And I'll
Okay.
talk a little bit about revenue recognition. We could probably spend a full hour on revenue recognition.
Yeah.
So I'll
we're coming,
just point out some high topics here.
We have about 10 minutes left, just so you know.
We do.
So, okay.
So I'll touch on a couple of revenue recognition items here. So many audit risk areas, as Julia said, are tied to revenue, and it's mostly because revenue is material to the financial statements. The recognition timing depends. The timing directly impacts your reporting results, and often the nonprofits have multiple revenue streams. So it could be, membership, special events, contributions, grants, contracts, and so on. So different rules apply depending on the nature of each transaction. Looking at contribution versus exchange transaction. So your contributions, that's supporting the mission, and the exchange is the goods received or goods and services of value received. And really the audit prep is identifying those revenue streams in advance and documenting the treatment right away, as Julia said. So membership dues with tangible member benefits, special events or galas where tickets may include meals, entertainment, or other values, and sponsorships that provide advertising or access or any other benefits, and the fair value determination for goods and services provided.
And this is an area where probably many of you have already set in, but we can easily have an hour just talking about this.
We could. And we often see, a lot of difficulties with this with our clients. And as Julie mentioned, that's where we're happy to chime in and help out when we can. So looking at sponsorships with multiple components. So a single agreement can include multiple revenue components. And it's really important that you're ongoing accounting. So you're identifying and evaluating these components at the time the agreement is executed. You're assigning those values to the components, the fair value. You're allocating revenue based on the values assigned and recognizing the revenue as benefits are delivered. So as you prepare for the audit, you're confirming the allocations are reasonable and that it's documented, and you're ensuring that revenue is recognized properly and consistently. Special events and galas. So these often involve both an exchange and a contribution transaction. So just again, identifying that at the time it happens. Ticket prices may include meals and entertainment. Revenue must be split between the exchange transaction and the contribution, and it requires reasonable and consistent fair value assignments. So the fair value is the exchange, and anything in excess is the contribution.
And we see this a lot. And I think you all see it too, because you see it on tickets. Sometimes when you get a ticket to something, it tells you what the fair market value. You might have a dinner and you paid $250 and they'll say the fair market value was $50.
In-kind contributions. We have a lot of clients with significant in-kind contributions. One that stands out in particular, they receive a lot of food donations for meals that they provide to those in need. So you have to value those and disclose those properly in the financial statements. I won't go over too much detail here, but just another service that is frequently in kind is your legal fees. We see a lot of legal expenses as in-kind contributions. Just making sure that those are properly recorded throughout the year and before the audit begins.
Talk about the very last point there, Sally.
The not qualified piece.
Yes, yes.
Yes. So in-kind services are not your general volunteer hours, your fundraising assistance, or board service. So really to be an in-kind service, it does have to have, it requires those specialized skills that are provided by a person. So like the IT, legal, accounting, those kind of services.
Thank you. I just think that's an interesting note.
Yes, thanks. We're speeding through these time.
We're good. We're good.
I'll talk a little bit about IT controls quickly. So a recent accounting standard came out, it's SAS 145, and it really requires auditors to dive much deeper into IT controls and systems. So it's really important that you have considered your organization's IT controls that are in place and the processes. As auditors, we are probably going to ask you to see who has access to different systems. So who has access to your general ledger, bill.com if you use bill, and just making sure that access is appropriate. It's important that maybe you have a approval workflow or audit trail that you are looking at these access roles maybe quarterly, just ensuring that any turnover, the access is removed, any new employees, that the access that they're granted is appropriate for their position. Dominic, anything you want to add there that you've seen from an outsourced accounting perspective?
Just one thing that comes to mind is when you're looking at the roles and responsibilities in these software platforms. So one big one is bill, for example, that's pretty prevalent, is who should be the administrator on that account. So oftentimes we'll have someone from the client side want to be the administrator, but that person is involved in the day-to-day functions of accounts payable. And so we generally would say that's not a good idea because then they have too much access. So then we try to get to the heart of, okay, what are the different roles they're trying to fill? And then we could create a custom role or satisfy it with one of the existing roles. Administrator typically could be the outsourced accountant or someone who's outside the day-to-day operations. And just one example on that that we have found to be a problem is administrator can add or remove users. And so sometimes if you don't know how the systems interact with each other or what happens when you remove a user, that can be problematic if someone who's not familiar with how the software works is in there, administering that function. And one example that I can build on with this is with bill spend and expense, which is an ancillary tool tied to bill for the credit cards and virtual cards. If you have someone who is involved in accounts payable and not with credit cards or vice versa, if you delete them from one system, they get deleted from the other one. And so if that person has credit cards already, their credit cards will be deleted. And that's a problem. So you really want someone on the administrative side to be, again, someone who's outside the day-to-day operations of that function, and also someone who's really, really in tune with how those software packages work.
Thanks. Julia, do you want to talk a little bit about a first
Yeah,
year audit?
I won't spend too much time on this because really the whole gist, there's two slides here, but the whole gist of it is that if it's your very first audit, it's going to be a bit more painful. Let's just say that they're going to be asking for more information, and the time commitment is a lot more sometimes than what you expect. But your auditors will work with you because we've been through it a lot of times. I'm working with someone right now, it's their first year audit, and the team is geared up, and we've been working in partnership with them to get ready for this first year audit. So don't be afraid. It'll all be fine, but it does take a little bit more effort. And the next slide, I don't know if it says anything. It just reminds you the focus is going to be through walkthroughs, financial closes, cash disbursements, IT controls. We're going to be walking through all of those different areas. And the only other thing I wanted to say is that when you change auditors, again, you might have a little bit of this too, because the auditor is not as familiar with what you do. And so the walkthroughs will probably take a little bit longer. But most auditors will spend the time to look through the prior year auditors' work papers, and most of us are very familiar with a lot of things. So we do a good job of getting you through that too. But just know when you change auditors, or if it's your first audit, it could be a bit more time consuming. And it is important to stay current with GAAP. Your auditors will help you with this. We always make sure we update the client on anything that we see coming up, and the boards too. When we see something coming, we're gonna let them know. And I think the last one that was big was the leases. And for some reason that kept getting delayed. So we were talking about leases, it felt like for 20 years. It was probably 3 years, but it got delayed a few times because of COVID. But so they heard about it a lot. But then we worked with our clients to help them implement leases. So work with your auditors on things like that.
Common
Anyone
audit
else?
challenges.
Mhm.
Probably the most important and most frequent one is just incomplete or inconsistent documentation. So again, making sure those reconciliations and the reports that you provide the auditors agree to the trial balance. Misclassification of revenue or contributions, just reviewing the revenue and the contributions, ensuring the proper recording, making sure you're taking into account any of the restrictions or conditions that are on that revenue. Missing accruals or cutoff issues, delays from incomplete close or disorganized team. Again, when we include the whole team, things seem to go much more smoothly. And this is definitely an area where we see if there's been a lot of turnover, especially in the finance area, things can be delayed just because the close did not happen timely. It's just a lot more disorganized. So just encouraging you to have the whole team on board and implement that timely discipline, as Julia likes to say. And note that challenges can be both process related and technical. And sometimes, material weaknesses and certificate deficiencies sometimes elevate as a result of these challenges here.
And one of my big hints is always look at whatever adjustments you had last year and make sure you've addressed those areas, because if you
Yeah.
didn't do anything different, probably had the same adjustments again this year. But that's just a
true.
little side hint.
That's true.
That was free. I gave you that hint for free. So again, the key takeaways is smooth audits result from continuous discipline, my favorite word. Audit readiness is a year-round effort, and risk-based audits focus on judgment and complexity. And that's just common sense in a lot of ways. And then just clear ownership and coordination prevent delays in your audit. So I think that concludes our presentation.
Yeah.
Are there any questions right now or anything that we can help you with? Well, we really appreciate your attention today, and we appreciate that you joined us. We feel very strongly about auditing and our CAS services. We find this fun and exciting, probably more so than the average person would find this exciting, but we do. So thank you so much for joining us, and have a great day and a great week. And we'll pray for that snow, Chris. I think it was Chris who wanted us to pray.
Thank you.
Okay, thank you.